Passive Pockets is presented by Equity Trust. Passive investing continues to draw in investors looking for financial freedom without the burden of active management. But it's not without its challenges, especially in today's uncertain market. How do top investors find deals, assess risk, and stay diversified through market shifts? Welcome to Passive Pockets, the passive real estate investing show, brought to you by Equity Trust. I'm your host, Jim Pfeiffer, together with Paul Shannon. Today we're joined by Pascal Wagner, a seasoned passive investor and host of the Passive Income Playbook on the Best Ever Real Estate Podcast Network. Today we're diving into strategy, risk, and Pascal's unique approach to navigating today's market. Let's jump in. Pascal, thanks for coming. Welcome to the show.
Thanks for having me, Jim and Paul. I'm excited to hang out with you guys.
Awesome. So the way we want to start this one is, you're a limited partner investor, and I love hearing these stories. So how did you get into active real estate? And then talk a little bit about why and when and how you switched over to passive investing.
My story started when I was 23. My best friend, Diego Corzo, came up to me with this proposition after reading Robert Kiyosaki's Rich Dad, Poor Dad, that he wanted to buy his own house and do the strategy of house hacking. I saw how profitable the strategy was. Then we started buying a couple of those together. So my journey started at that point when I was 23. Since then, I've been buying and selling. I've bought in Austin. I've bought in Charlotte. So I've kind of had my hands in real estate from over a decade ago now. In terms of how did my story shift to more passive, in 2021, my dad passed away from old age, kind of unexpectedly, I think, as no one really plans to die, but he had then left my mom a major inheritance of several $1 million. And there was no plan for how to live off of that or to have my mom basically continue staying in retirement and fund the rest of her future. Her not knowing anything about finance or money management or any of that, because that's what my dad did as his kind of role in the family, I had to step up to the plate and figure it out. I think one of the first things I did was I invested in what I knew how to generate cash flow. The whole goal was, how do we build a six-figure portfolio for my mom to live on? We took most of that money and started investing in this co-living strategy where I buy single-family homes and rent by the room. That all went kind of swimmingly. We kind of grew to an 11-property portfolio, but I slowly began to realize that, okay, this strategy does not make sense. I can't have all of her net worth and all of our cash flow tied to this single strategy, the single city, the single asset class. And so, I did probably what most people do is I reached out to a bunch of different financial advisors. I got, the advice of doing some sort of stocks and bond strategy or something that was related to the market. I decided that was not the play. That, I just know that from being in real estate, that made so much more sense. I was in a mastermind group called GoBundance. There are basically like many mentors I had in that group that were already retired who lived off of their passive investments from being in a bunch of different funds. And so I kind of looked to them to help guide me and what are you investing in and what mistakes did you make? And basically took all that and started figuring out what my own portfolio would look like. That's kind of the part where I started making my first passive investment, and we can go into detail there if you'd like to.
Yeah, that's great stuff, because I think it's interesting, right, that you went to, well, we have all this money, so let's go to financial advisors and see what they say. And shockingly, right, they said invest in paper assets. But fortunately, you had real estate experience, so you said, okay, maybe not. Maybe I'll go find the qualified people I know that are already doing real estate in a different way. And we'll talk about diversification and other things later. But I've seen you on social media writing about replacing your income, and you say replacing your income is a skill. That's what you did for your mother. So can you talk about why that's a skill and what that means?
I coach a lot of people now on how to do this because, when I started, the first thing that I realized is that there are a bunch of people who will teach you how to go raise money and how to be a real estate operator. but there are not many people in this space that teach you how to be a professional LP. There are a lot of communities, and I definitely leveraged all of that, like the Left Field Investor, now PassivePockets, Best Ever, the 506 Investors Group, Long Angle. There's a ton of groups out there, and those were really impactful in my journey. But you spend, all of your life learning how to make money, and then you have to learn the skill of investing, and you're learning how to invest for growth, predominantly. And then, I guess towards the end of your life, the stage that my mom's in, it's more about how do you turn that portfolio that you've prioritized growth around to now start paying you in cash flow. And if you look at the landscape of all the things you could invest in, right? My focus is cash flowing assets. So that could be anything from multifamily housing to industrial real estate to triple net leases to oil and gas to different business partnerships like the ATM deals that have gone around, the car washes. There are so many different things that you can invest into, and all of them have their pros and cons. Some of them make more sense based on what you're trying to do, if you're trying to offset active income or passive income. And so I really relate that to being a skill that must be learned. You don't just come out of the womb knowing how to do that. And I think if you think about it that way, as hey, I need to figure out how to turn the money that I have into something that cash flows, that is a skill that needs to be learned.
Love that.
Pascal, I had the opportunity to meet you at the Best Ever conference about a month ago. And I've been looking forward to this interview because I always like to hear the perspective of other people that have transitioned from active and into passive investing. But after hearing your background over the last few minutes, I'm even more excited to talk to you now. I think you have a great breadth of experience and certainly probably a different take on the industry than many do. You talked a lot about learning how to invest and really understanding the landscape and aligning risk tolerances, I think what you're getting at. But such a big, crucial factor to being successful in passively investing in real estate is choosing the right operators, right? It's almost sometimes more important to invest with the right sponsor than it is to invest in a particular deal. So how do you go about the process of vetting operators and discovering operators that you might be interested to invest with?
Everyone talks about don't bet on the deal, bet on the jockey, the operator is what matters. And I 100% agree. But what I will tell you is that I think it's a step back from that. I think one of the biggest mistakes that people make is they are really focused on a specific strategy or trying to validate an operator's track record. And a lot of times people will bring me deals that are completely out of alignment with what their actual goals are. Hey, I'm trying to replace 6 figures of income, or hey, I'm trying to offset this big tax event, or hey, I'm just in this really for equity growth. I like the cash flow component. I wanted to just kind of take a moment there and say that, I think there is a lot of focus on how do I vet the operator, and I'm happy to go into details there if that's what we want to do right now. What I find with me and just all the people I've coached is they focus on that part now because, it's fair, right? We talk about it in all of these podcasts. Going back to what are you actually trying to achieve with the investment is, I think, the part that people skip. And I think actually more focus needs to be put there.
Do you mean on the overall strategy or the individual deal, the strategy of that deal? What are you talking about when you talk about strategy?
Yeah, I think about it like the overall thing. There was one student of mine where she came to me with this deal, and it was a multifamily value added deal. 5-year hold, and it had 8% cash flow projected. We're talking about focusing on the operator. We looked at their track record. We asked for, hey, can you send us investor updates from your previous deals so we can see how those are performing and what you're actually telling your existing investors, and actually going through and doing the due diligence on what a track record is. And she realized that this is actually a deal that I'm trying to use the money that I invest in this deal to pay for my kids' college in 2 years. And my money's locked up in this deal. I don't even need to look at the deal or the operator and vet the operator because it just doesn't even make sense. Another example would be where I'm interested in cash flow. And then we look at a deal where it's a development deal and it doesn't generate any cash flow for 3 years. And we all know that after they finish developing the thing and they lease it up, that company is going to sell the property. They've taken out as much value as they can in the deal. Like, it's not a cash flow deal, you know? I do see a lot of that happening. That's where I think the mistake is.
A lot of times investors don't match their goals to the deals that they're investing in. And oftentimes they don't know the risks they're taking. They don't understand the risk premium that's really required to take on the illiquidity, take on the additional risk. They don't look at the overall portfolio construction. And that includes not just the passive investments that they have, but also stocks, bonds, precious metals, just the overall big picture and where that investment kind of fits in. So I love that approach. I think it's really smart to look at it that way. And obviously you want to know, like, and trust the operator that you invest in. And ideally you've got, others that you can kind of bounce off the investment ideas with, and those that maybe have invested with that operator before. But let's assume that, you trust the operator, you believe in their track record, the deal does fit into the goals of the investment. Are there specific ways that you like to kind of break apart a deal and analyze it? Are there metrics that you look for, or assumptions? Are you looking for, the big three: IRR, cash on cash, equity multiple? Or are you kind of digging deep into the spreadsheet? What's your approach when you get to that level of analysis?
I can tell you it's very different today than when I started. Today, my process is I have a 100-point checklist that I go through. Every time I hear an interesting comment or an interesting thing to look for in a deal, I just add those questions to my checklist. And not all the questions are relevant for each deal, but they could be anything from like, okay, how many deals have gone full cycle? Like, what does their background check say? Like, do I understand what the DSCR rate for this house is or this building? Do I know what ownership percentage each person has in the GP operating team? And like, what are those dynamics? Like, they're just interesting things that I've picked up from each podcast. Over time, I've developed a couple different hacks that I like to call them. One is one I just referenced here earlier, which is like, okay, you want to know how a deal is actually performing. You're looking at an operator's track record. You see that they have 10 apartment buildings that they currently own. In the slide deck, it's a very crisp, clean, sheet that shows you, oh, we've improved NOI this much, or here's the anticipated return, or anything like that. What I do now is I say, hey, can you send me the last investor update that you sent to your investors? Because now you are digging into the real performance and the real details of how they're communicating with their existing investors. And they might be, hiding things from their existing investors. It doesn't stop that from happening. I'm not trying to put extra work on the GP. I understand, they have a life, they're trying to run their business. And I am still trying to validate, the things, trust but verify, and trying to find unique ways where it doesn't put a huge burden on them. It should be assets that they already have. I think there's a $70 million debt fund that approached me, and I was looking at one of their deals, and I asked them, hey, can you send me the loan tape? And they were like, oh, we don't have something like that. And I'm like, I don't know, like, what's up here, but like, if you don't have a list in a Google sheet or something that tells me exactly what loans you have and what the rates were and like which ones have expired and which ones are new. But when you're a beginner, you don't know to ask for those things. When you get into this space, learning what you can ask for, what to look for, would have saved me a lot of money.
Yeah, and when you look at those checklists, like you have a 100-point checklist, I have a checklist also, and some of it's vetting the operator and some of it's analyzing the deal. And, just as an example, you mentioned how many full cycle deals do you do? And I think a lot of investors are like, check, I asked that question. They said 6. Okay. They said none. This guy said 20. What do I do with the information, right? What do I do with that? The person that says 6, is that good? Is that bad? Does it matter? So I think that's one of the things that I'm trying to figure out. Like, I'm asking these questions, but which ones are the meaningful ones? And what do I do when they give me an answer? What do I do with that? How do I qualify that? Can you talk about that a little bit?
Look, I think this is part of the nuance of coming up with your own understanding and opinion for investing in a deal. Someone says, hey, I haven't had any deals go full cycle. I think the point there would be is, okay, I just know that that's an unknown. It might not be a deal breaker for the deal unless that's part of my criteria that I only work with operators that have gone full cycle on X number of deals. If someone has done 6 and all those deals happened before 2021 when you could have just bought a property and held on to it and done nothing to it and sold it for more, just because they went full cycle doesn't mean much. I think knowing what I know now, what I would focus on is like, all right, so you had 6 deals during this major time period run up. I've learned over time, what do operators have control over? They have control over the net operating income improvement on their building. And so if, their plan was to improve NOI by X and they only did it by Y, like I'd want to understand why, because in this environment, that's totally different, right? It's hard to teach that or just pick some of those things up in these podcasts, but it's in understanding the nuance.
Right. And that's the point, right? I said 6, and then you say, well, if it's 6 deals that they started in, 2017 and went full cycle in 2019, well, okay, I was an asset manager then and had some success and I didn't know what I was doing. So that tells you that it doesn't necessarily tell you that they're good or bad. It just tells you, okay, they rode the market. But now you're telling me they had some other full cycle deals in difficult times. It just gives you questions to ask. And I think what we need to help LPs understand, and what I'm still learning on my journey, is it's not really about how many deals, but it's the great example you used. It's about when those deals, what those deals, how it all came together. So I thought that was a great answer.
Well, I just think it kind of ties into what Pascal was saying about the NOI comment. If you intended for it to be X and it ended up being Y, one of those possible outcomes as to why it was Y, quote unquote, was because of the macro over the last couple of years. And I'm just curious to get your take on how much you factor in what's happening in the macro picture to your investment thesis, and how much slack do you give operators who maybe haven't had as good of an outcome as they intended to. And some of them just say, hey, the interest rates went up, we didn't expect that, or the 10-year is what it is, or whatever they're going to tell you. How much of a factor is that for you? I mean, I look at it sometimes like, hey, you should have saw that coming. And other times it's like, okay, nobody could have saw that coming. So just curious on what your take is on the macro.
Huge impact on the macro. I think due to the aging population, the baby boomer population, I think the next decade is a great time period to be investing probably in assisted living type things, because there's not as much inventory. We're at the beginning of that cycle, I think. I was looking at an RV campsite fund with a student, and I think that's on the downslope. I think if they had record returns in the last 4 years when people just had COVID and people were buying Sprinter vans, and there's, people are traveling all around the world, and now, people are going back to the office, and I think that's on a downward trajectory. So I think the macro has a huge impact on these types of things and greatly influences what I think around that. The point I think here is it's easy to poo-poo on maybe an operator who did poorly and say look, I'm not going to invest with them. I think there could be many reasons why deals have gone poorly that are maybe not even the fault of the operator. Rising insurance, rising property taxes. There are a lot of these things that happen that I think are hard to plan around. But I think the question that I think is also not talked about enough is in context to what? So everyone has a deal come into their inbox and they start looking at it. And they're like, oh, this kind of looks like an interesting deal. And it's like, when I worked at Techstars, I looked at over 3,000 deals. And at the beginning, I will tell you that every deal looked awesome. And by the end of my tenure, you could really understand which were average and which were outliers. And you only get that perspective by understanding all the other deals that you could potentially look at. So if you're looking at, I'm just going to pick on multifamily apartments, there are hundreds of multifamily apartment operators who you can go and say okay, I'm interested in this sector. I have this deal in front of me, and okay, maybe the operator didn't do as well, but let's compare this opportunity and this operator to the others and let's make a decision based off the context of all the deals and operators I could look at instead of in one. That question is easily answered then if you see another operator that doesn't have an issue and is using the same strategy and yada, yada, yada. And if there aren't, if everyone in that space had done poorly, then it's kind of irrelevant. I think the context is what matters.
I love what you said there. I mean, it's all about getting the reps. And Jim, we talk about that on the deal review series, right? It's about looking at deal after deal after deal. You get that constant practice in and you start to see, wait a minute, that looks very similar to that other deal. And maybe this is an outlier, or man, that's run of the mill. That's just, that guy's marketing this really well, but probably not the best deal. Practice makes perfect. So sorry, Jim, I think I cut you off earlier.
No, that was perfect because it puts into context what Pascal just said also is that when you're looking at, okay, is 6 deals, they had 6 deals go full cycle. What does that mean? Well, if you've looked at 100 other operators, 100 other deals, and you can see it, it's all relative to everything else. And so what I learned, we have a deal analyzer at PassivePockets, which is kind of like a checklist, and we throw the numbers in there. And what I learned, the first couple of times I'm like, what am I looking at? I don't know. I'm just throwing numbers in a spreadsheet and some things turn red and some things turn green, and apparently red's bad, right? And what I used it for was a question generator, but now I use it as a question generator for sure for the operator, but I also use it because I've found out from doing 100 deals in this analyzer, what are the 6 most important things to me that I tend to focus on? And they're usually things like, oh, if I look at these 6 things in this deal, that'll get me to know quickly, to know as in, I don't want to do that deal. And that's the goal, right? Every time you're analyzing a deal or an operator, you're trying to figure out what is that? How do I get to know so I can move on to the next one and find the gem? So I think that putting it all in context makes sense. Now I do want to talk a little bit about diversification. And Pascal, you recently posted something about you're in a debt fund, right? And you're talking about why cash flow is important. And then you're talking about it's a fund, so you're diversifying and you have diversification. And so I want to talk about different types of diversification, right? Because when I think about diversification, the first thing I think of as an LP is I want to be with different operators, different markets, different asset classes. And I understand there's other ways to diversify. And then you're saying, well, I'm in this debt fund that's paying me a lot of cash flow and I love cash flow. And it's diversified because there's a lot of different notes in the fund. So can you talk about diversification and why in that fund you're diversified, but you can also diversify in other ways, if that makes sense?
Look, I think the post we're all referencing, if you don't follow me on LinkedIn, that's like my primary platform. It was more geared towards, if you haven't heard of most people don't know about these types of investment funds. In some cases, you don't need to invest in just a single project. You can invest in these funds that have, hundreds or thousands of loans. I generally like being in funds more because they reduce the volatility of my investment. They might not have the potential to produce as high of returns, but for that trade, I get less volatility, which is what I'm primarily investing in real estate for. I have equities and crypto that are full risk on that are completely volatile. And I'm happy to make that trade there. So I think that's point one. But I'm with you. I want to have diversification between operators and asset classes and strategies and geographies and vintages and I think there's it's all of those things. I think I'm in 5 different funds that are just like debt or private credit with, 5 different operators. I've got, oil and gas. I'm in triple net. I've done the gamut as well. And I think I'm a big advocate of that, especially as I've just learned that you can get locked in to some of these funds or the funds do not perform as well as you think. I've experienced that firsthand. And so the more concentrated you are, the more volatile your net worth and your investments are going to be.
Going back to the macro again, this is where my head's at most of the day is thinking about the world's current events and what's happening with the administration and tariffs and, speaking of volatility, right? It's like there's a lot of it right now in the stock market and the bond market. And what I like passive investing is that you're illiquid and you're sort of like you made your decision quite a while ago and you don't see that volatility day to day. So in theory, your net worth is still intact while all this other stuff is happening around you. But you also, don't want to be sitting idle in cash, and inflation is real and maybe it's stagflation. So you can see your wealth erode pretty quickly if you just hide your money under the mattress. So what are you looking at today as attractive options to invest? And how are you kind of managing your capital and your deployment of it with this economic uncertainty?
Well, I think this is probably different for everyone, but it's dependent on like how liquid you are, right? I am largely deployed. I've got a couple 100K left that I'm kind of just sitting on right now that I actually slowly been getting into the crypto market because they're at lows and I'm long-term on crypto. I think now is the time that you would want to be investing in equities. And before, when everything was sunshine and rainbows and the market continued going up, is when you would want to diversify into more of these illiquid, maybe more less volatile stocks. And I think that's the play that I made. And so to me, it's like when things come down, that's when I want to buy. Macro wise, I generally think that this will probably be one of the better decades for investing at home in real estate. Like, whether you think Trump is going to bring back manufacturing or to what extent, I definitely see the, America First policy more focused on real assets versus paper assets. And then you think about like, what are the big 10-year, 20-year trends? The baby boomers are now getting into assisted living care. That is the demographic that's going to need the most, medical care. And so I think if you're, investing in anything like that, I think those are interesting, good bets. Like I said, I think like the RV stuff or the campsite stuff is probably on the downslope. I wouldn't be looking at things like that. I had an interesting podcast with a gentleman who does industrial. I think if you believe that America is going to become more of a manufacturing nation than it is today, then there will be more demand for that type of product for businesses. Money is made in these opportunities, right? When these macro things shift.
It is. And, one of the biggest mistakes I made was liquidity. And Paul mentioned liquidity, and you kind of talked a little bit about it, Pascal. And I know you don't have a bunch of liquidity now, but, kind of to close out, can you talk about for new and experienced LPs, this type of investing is so different than you're used to, giving money to your money manager, your financial advisor, or just doing mutual funds and stocks on your own, because you can pull money out and put money in. And as Paul said, sometimes being illiquid is great because it stops you from doing that. It stops you from making mistakes. But also, if you go too all in this type of investing, the illiquidity catches up with you. And that's what happened to me is I was so excited about all this. I just want to go. And then I realized, oh, wait a second, I'm not very liquid. So can you talk about just the importance of managing liquidity and how you view it?
Okay, I think I have a new controversial take on this. One of the big reasons why high income earners move into these types of assets, passive investing, is because they offer unparalleled tax breaks. And they often let like, oh man, I'm going to pay several $100K in taxes or something like that. And I need to invest in things that might, lower my tax burden. Some people go into oil and gas, I think is a gateway drug into passive investing. And then also when people get into this space, you want to believe in these IRRs, in these projections. And, they give out these pro formas and you understand how the real estate works and how the business makes money. And so you're just like, oh, like you want to believe it's true. I think most people go into passive investing first investing into equity-based deals for those reasons. I actually am now going to say that I think that is the wrong way to approach it. When you are doing something new, and passive investing is an entirely new skill, like I said, different than investing in the stock market, to tie it back to the beginning. Going and doing the hardest, thing where there's the most volatility, where you're locked into 5 or 10 years and you've never done this before, you couldn't list 10 different operators who do this one strategy. That is the hardest thing to do, and that's where most people start. I actually think you should be starting on the debt side of the equation, and here's why. Unlike an equity deal where you might be in a value add or a development, like whatever they need to, those are the strategies that generally produce these high IRR type deals. You don't see cash flow for 1 or 2 or 3 years. You don't really know what the reporting is like. You probably didn't even ask for what the reporting looks like. And you're sitting there wondering, is this working? Is this how it's supposed to work? Like, I have so many people come to me and they're like, I'm afraid to kind of like make my next investment because I don't know how it's going, how it's doing, if it's on track. They're telling me it's on track and I'm just believing them, but I see nothing in my bank account. Whereas with the debt fund, within 45 days, you should be receiving your first check. And you should be getting, monthly or quarterly updates from these people. And you have the ability to pull your money out. You get to have the training wheels to go work with a debt fund, and they're also safer. They're in first position versus being in second position in terms of the capital stack. And I think that's where people should start. When you go learn how to surf, you don't get the Kelly Slater surfboard that's, 6 feet long and you go ride 8-foot waves for your first time.
Well, Paul did, but most don't.
Yeah. You get the 10-foot board that's super long and you start on the beach and you learn how to get up, right? And I think the same approach needs to be taken in this kind of investing. It's a new skill. It's completely new. I think that's honestly where people should start. When we're talking about liquidity, that is the most liquid and the best way, I think, to learn and get going.
I love that. I think that's a great piece of advice. And I think, it's hard because you get so excited, like you want to do the stuff with the big returns, but starting out small on a board that makes sense for you, 100%, that's fantastic. So Pascal, if people want to go surfing with you or follow you or learn more from you, what's the best way to do that?
Best way is to go to PassiveInvestingStarterKit.com. It'll take you to a landing page where you can sign up for my starter kit. It gives you 25 of the latest deals I've come across. I aggregate all the deals that I see, sign up on all the different operators' websites. I put them in a database and share them with my list every Friday. And I'm also big on LinkedIn. So just look for Pascal Wagner.
Awesome. Well, thank you for being on the show. This has been fantastic.
Thanks, Pascal.
Thanks for having me on, guys.
That wraps up our conversation with Pascal Wagner. He had some great insights on strategy, risk, and how to get started on your passive investing journey. If you enjoyed this episode, be sure to like, subscribe, and leave us a comment. For more education and tools to support your passive investing journey, visit www.PassivePockets.com and check out our 7-day free trial. Thanks for listening, and until next time, stay informed and happy investing.